Alrighty, hello everyone. Let's go and get started. Welcome to this week's TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and most of you are likely familiar with me by now. But if you're new or joining us for the first time, welcome. It's great to have you on board with us. We have to go over some housekeeping details about the session, then I will introduce Rob for the future presentation. So first and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Please feel free to read this at your leisure on our website, or take a screenshot of it now if you like, but that's the main point to take away from it. Just going to leave this slide up for review for when we get to the Q&A process of today's session, or tonight's session rather, or depending on where you are, it could be today's session, but that covers off the housekeeping details. A hotter than expected CPI report derails the market rally, and the weekly U.S. market update on the weekend, Rob suggested that the market was about to pivot. Pivot it did today, and I look forward to hearing what he has to say about that now. And of course, excited to interact with you all. So thank you for joining us for this live session. At this moment in time, I'll introduce the man of the hour, Mr. Rob Roy.
Hi, everyone. Welcome to this week's TradeFinder. And Zach, I know you're fighting some things with your throat. I hope that makes it through okay. I was able to get back from the Big Easy okay. Attended my first Mardi Gras over the weekend, and that was certainly an experience in itself. Not as big of an experience as what the market had today, though. As Zach mentioned, the CPI report came in, and it might have been a little confusing to some because so it was a little hotter than expected. And then behind the scenes, some things actually went up, like shelter, food. There were some components that did move higher, and boy, that sent spook into the market. I did mention that in the weekly update, as Zach mentioned, on YouTube. If you haven't visited our YouTube channel, please do so. By the way, I saw a few comments of first-time viewers for TradeFinder. Welcome. And if you've not visited the Elliott Wave Options page on YouTube, please go there and subscribe, and you can participate, see those U.S. market updates that come out each and every weekend. And I highlighted this rising pennant pattern that we have. It is a breakout pattern. You all know that I'm more of a fan of triangles, ascending, symmetrical, or descending. These are breakout patterns as well, pennants. You can see where it got its name. It looks like a baseball pennant. And often when you have a rising one like this, it indicates a downside breakout, which is slightly different than the other triangles where you can break either direction. There's been a headline on the Fed refuses to pivot. So that's where the thumbnail is the market going to pivot. And so that was the move to the downside today. Now, where do we go from here? That's where it gets interesting. So we gap down. And you know how I feel about gaps. Gaps get filled. We don't always know when. You know, we look at the 10-day moving average. You can see we closed right on the 10-day moving average, and we opened right on it. So we have a doji today. So we have a gap down and a doji right on the 10-day moving average. Tomorrow's up for grabs. Who knows if we go back up and fill the gap? Do we continue lower? I have no idea what's going to happen tomorrow. And clearly by this big doji, the market doesn't know what's going to happen tomorrow either. So we're just going to have to wait and see. At the time we're starting this, the futures are basically flat, so no indication there. But we could possibly be starting this wave 4. It's too early to tell on one day. Again, we could rally back up tomorrow as people start to digest this, but it was a rough day for the financials. I think the main thing, more than was a CPI a little hotter than expected, or did we stop the downtrend, which technically we haven't in inflation, is the fact that it just pushes the Fed rate cut out further. I think from this, Jeffrey Gundlach, who I quote often, as you know, I follow for the bond market. I think you need to have a good working knowledge of the bond market if you want to be a good equities trader, to be a bond expert. He's viewed as the bond king. They get him to comment every time the Fed has a meeting, and they had him on again today. And he says that it'll be June at the earliest, if at all, for a rate cut. So he's kind of more more hawkish on the Fed than some, just pushing it out. Is a whole lot different than if there's even a rate cut this year. So we'll have to see how the market reacts to this move today. We want to look at volume when we see a day like this. Volume always matters, and you can see it was a lot of volume as you would expect. Perhaps it was just an excuse for profit taking today, and maybe we slowly climb back to the upside. When you see the VIX, you'll see that there was certainly some volatility in there. There was some really interesting commentary from Rick Santelli on CNBC, which is one of the few people that'll get me to turn the volume on. Normally, I watch it with the volume off. As you know, you've all heard the stories of breaking a TV, et cetera, over some of the comments. But he was talking about how there's a reset in interest rates, and that kind of pushes them what seems to be a lot higher than where they really are. And you can see that when you take a look at the chart of the 10-year. It was really interesting commentary. I encourage you to find it, listen to it if you can, if it's out there on YouTube somewhere. But you can see this big move to the upside in rates. We broke out of this range where we've been holding with the 42 level acting as resistance, bumping our heads against it numerous times. Well, we blasted right through it today, but we're not even at a 50% correction yet from this big move down in rates on the 10-year. So the 5-wave pattern is still intact. It hasn't changed. It hasn't relabeled. It hasn't disqualified. We just moved the floor up a bit. And if we look at the 10-day moving average on rates, you can see that we were on the 10-day moving average on the low and closed at the high of the day. So kind of some separation there. Maybe that means a little bit of backing and filling in rates here, which would allow the market itself to calm down a bit. So certainly need to keep an eye on rates. And then the dollar, I think, is interesting as well. Big, huge outside day on the dollar. We had gone sideways right at the 61.8% fib level. You can see right at 104 there for a week or so. We were just right there, which was also resistance. So we had both interest rates and the dollar at key resistance levels, and once again blew through it. For those of you not familiar with what an outside day means, the high of the day exceeded the high of the previous day, and the low of the day exceeded the low of the previous day, hence the name outside day. The bar completely encompasses the entire previous day and really the entire week, basically just in one move. Now, this is a little bit concerning. I mentioned that we wanted to see the dollar stay in a range. That was the most constructive thing for the market. We don't want to come up and test these highs from September and October in the dollar. That starts to become problematic for companies' earnings that have international exposure with exchange rates, et cetera. That's not a positive thing. So we do want to watch this dollar. We're up at a 68% correction now. We're getting awfully close to where this 5-wave pattern would disqualify. And that could mean, the Fed's been saying this kind of, I think. A lot of people have come up with the phrase, how the media works. They have to have their catchphrases higher for longer, and higher for longer would certainly be supportive of the dollar. And that's not good for earnings, as I mentioned. And then here's the VIX, and there's that big spike in the VIX. And we've been talking about whether or not we were going to get some sort of a move. We had kind of gone into this channeling effect here, where we were getting higher highs and higher lows. And then we broke out of that to the downside at the end of last week, and then right back into it yesterday. And then, of course, what happened today with the big spike all the way up to 18 on the high. The VIX did back off, closing just below 16 by the close as the market calmed down a little bit towards the end of the day. But big, huge spike. Is that it? Is that all we're going to get out of the VIX, or is that one of many spikes? Oftentimes, as you can see, when we get these big moves, there might be a couple more before it calms down again. You can see every time we get these big spikes, there's lots of activity that usually happens when it starts. So maybe we get another volatile session tomorrow as everybody tries to assess when could the rate cut come, if, as Jeffrey Gunlock says, at all. I still think that maybe a little bit of an overreaction today. I think, as I said, there was an excuse to take profits today. and people did that. And now we'll just have to wait and see how the rest of the week plays out. It's certainly going to be interesting to see. And the rest of the markets, as you would expect, followed suit. The Dow down a bit. It doesn't look quite as rough on the Dow. There's been this slow, steady incline here that really appears to be accumulation. That's the kind of movement that you get when the big institutions are accumulating, or in this case, they would be rotating. Maybe some money's been moving out of the S&P or the Qs and into the Dow, fearing that we're going to have some more volatility in the regular markets. We talked about the consumer debt, how long can the consumer spend, et cetera. And all these things are going to play out. Going to be really, I hate to use the Fed's term, but data dependent. The market's going to be watching all these. As you know, if you've listened to any of the videos, I've talked about this a number of times. The Fed doesn't really pay that much attention to the CPI or PPI. They like the PCE. So I think there's going to be a lot of attention focused on that when the next one's released. So a little bit of a move down on the Dow, but not quite as significant as the S&P, although we only hit the 10-day moving average on the high of the day. On the Dow, we closed below the 10-day moving average, or at least on the S&P, we closed on it. So that's a negative. If you're looking for a negative on the Dow, and then the Qs, as you would expect, they move lower. You can see that we had kind of a smaller pennant pattern here on the Qs, and it followed suit though and broke to the downside. Looking at the 10-day moving average on the Qs, closing just below it, but call it right at the 10-day moving average, also a gap. So the market's all gapping down, and that's because of the release before the market opened of that CPI report. We're at 100% extension on the Qs, and you have to wonder, is that it? Because it's already an extended level. The wave forward was only right at the 38.2% fib level, which gives you a first target of 61.8. And then the extended level, if it extends, would be to 100%. And that's what happened. So that's a logical point where we would find some resistance anyway at 100% extension. So I just kind of feel like, at least for today, we had an excuse for profit taking. And now where do we go from here? So we'll just have to wait and see. The markets are still discombobulated on their labeling, with the wave 3 there on the S&P, and then the Qs in a wave 5, the Dow's also in a wave 3. And then if we take a look at the IWM, you can see it's in a 5-wave pattern to the upside. We didn't quite make it up to the 210 level. If I take the Elliott Wave off, you can see that move to the downside there, gap down on the IWM as well, closing below the 10-day moving average here. We were wondering, since we held 190, were we going to go up and test 210? That was the range, if you remember, way back, 190 to 210. Then it broke down, and the range was 170 to 190 for quite some time. And now it looks like we want to come down and test maybe 190 again, at least this 50-day moving average. Now, if we hold here and you're looking for something positive on the IWM, a lot of people look at that for the market's tolerance for risk, because it's the small caps. And when they do well, it tends to mean that people are buying the market. They're taking on risk. If we can hold here, you can see that we'd be setting up for a little bit of a pattern here of higher lows. So that could be viewed as a positive, maybe in line with this 5-wave to the upside pattern, which is still qualified. But that gap down, gaps all over the place. Is that the start of a move lower? So we're going to gap down and continue lower, or are we just going to go back up and fill the gaps and then figure it out from there? So as I said, the rest of the week is going to be worth watching to see, how does the market take this after a big volume day with lots of profit taking. It's going to be quite interesting to see how the rest of the week plays out. That was for you, Zach. I figured you'd get a kick out of me saying interesting again. You say fascinating. Everybody got on me on that. So now I'll switch it to interesting. It seems to be my word that comes out a lot.
Got to switch it up every now and then.
Absolutely. Taking a look at Bitcoin, here's a place that is doing very well. We're trading just under 50,000, kind of holding in this area around 49,000. touched 50,000 and then backed off a little bit, closing at, well, not really closing. It's where we're currently trading now as well. But these are end of day quotes, even though it trades 24/7. But 49.5 at the time we started this webinar is where we're trading on Bitcoin. So holding in there. And if we look at the 10-day moving average, you can see that, yeah, we got a bit extended here on this big move to the upside. So we got too far away. That's the phrase. No security in any time frame gets too far away from the 10-day moving average, even Bitcoin. So perhaps we kind of base around this 50,000 level for a while. It's a big round number. Let that 10-day moving average catch up, and then see if we continue higher into the expected having it on April 18th. So that's what it looks like on Bitcoin. So as you know, we just pretty much marry coin with Bitcoin because everybody wants to know about Coinbase, and it was being dragged along with Bitcoin, but backed off a little bit, but not that bad considering what happened in the market. And that's obviously because it's following Bitcoin more than it's following what's going on in the market. And this move lower here was because of the fact that we started the Bitcoin ETFs, and people were wondering, is there going to be as much trading on Coinbase? But there's so many altcoins out there that maybe that was a little bit overdone. But the Wave 4 is holding right at its 61.8% fib level, so a strong point for it to hold. We've talked about this a number of times, that if you're long Coinbase, you really wanted to see it hold 120. That was key, because there was just nothing to stop it if it broke below 120 before it came down here into this 80 range or so. From this move up from 80 to 120, there's just nothing to support it on the way down. So holding above 120 is going to be key there, regardless of what happens in the regular equities markets. And you can see we're just a little bit above the 10-day moving average here as well. Same thing that occurred with Bitcoin, got just a little bit overbought here on the short term. And now we'll see if we can hold ourselves right here above all the major moving averages that are all right there together. 10, 30, and 50-day moving averages are all right conjoined, if you will, right at the same spot there, right around 130 on Coinbase. Looking at some of our international markets, as we do every Tuesday night, look at Australia, the EWA, and yikes, that was a move lower. We talked about how it was forming kind of a crude triangle, not the most well-formed triangle, but yet a symmetrical triangle nonetheless. And I say that because I prefer more touches of the trend lines. So you can see all this big open space right here and a big open space down here. But if you connect the highs and the lows, you do get a triangle. And then there's the breakout from the triangle on the EWA. And I'm putting the Elliott Wave back on. We're right down testing where that Wave 4 was at approximately a 50% correction. And so will it break that? Is it going to make a new Wave 4 low? Are we going to hold here around 23? 23 is kind of a key level. We traded through it a lot back in the summertime, as you can see right through there. And then it was a little bit of resistance in November, December, acted as support there in January, and now we're right back to it again. So 23 is the key level to keep an eye on the EWA. And then as we look at Canada, for our friends up north, looking at the EWC, also a triangle formation, maybe slightly better formed than the one on the EWA. If you draw the lines, you can see that it's kind of more filled in, if you will, also yielding a breakout. So none of these breakouts are surprising. Going back to the S&P with the pennant, and then all these triangle patterns, we're getting these breaks to the downside. The question is, do we follow through with these moves lower or not? We still are only at a 47%, call it a 50% correction on the EWC, and that level right there at 35 is an important level that could act as some support. So maybe that was it. Maybe this is a one-day phenomenon, and the market just starts to price in, all right, maybe it'll be a little bit longer than we want before the Fed starts cutting rates, and we calm down a little. We look at the 10-day moving average, we're quite a bit below it on the EWC. as you can see here. There's the 10-day moving average, and then we're way down here. So a little bit oversold perhaps on the EWC. And then looking at Germany, EWG, kind of the same type of thing. So all these international markets looked very similar with their triangles. And then the breakout today, I could argue that that may be the better formed triangle of all the ones. You can see more touches of the line there, which is how I prefer them, as I mentioned. Trading below the 50-day moving average, though, on the EWG. So that's something to keep an eye on. We are in a wave 5 still, but only a 40%. So call it the 38.2% Fibonacci support level, the fib ratio there. And it's not the strongest of all. It is a fib level, but I prefer the 61.8. But oftentimes things bounce off the 38.2% level and go on and reach their targets. We're starting to run out of time, though, on the EWG, so this is in danger of relabeling. As you can see, the 14th of February is tomorrow, and clearly we're not going to be up at that wave 5 target, so we might see a complete relabeling here on the EWG. Looking at the INDA, the market in India, that one will be curious to see how it's responding to all this, as it's been so strong. And it has come down, not quite as significantly as far as a gap, but it had already moved down a few days. So if you look from where the high is to here, you can say that that's about the same amount that the S&P dropped, or the other markets with their gap downs. Is just like kind of India was already ahead of things by moving down for a few days before. We're only at that 23% fib level on the wave 4. And as we've talked about, Elliott didn't really care for that. He liked to see the wave 4 correction go more than that, because there's times when just the 23.6% correction can just be kind of a blip on the larger wave. In this case, it doesn't appear that way because we have labeled the 5 now. But sometimes when you see that and it moves up, that 3 would just move and then this 4 would go away. But with the labeling of the 5, then perhaps we are in the wave 5 on the INDA. People have been cautioning to be a little cautious, a little conservative. This is the word I was looking for on the INDA, because it's had such a big run. And even with this little move lower, below the 10-day moving average, granted, but right now we're at the wave 3 high. You would want to see that hold. If not, then we probably are coming down to this previous wave 4. For those of you that may be newer to Elliott Wave, when you have a wave 5 that extends less than 100%, you have a correction back to the previous 4 once the 5 ends. And that may be what's underway here. Coincidentally, the 50-day moving average is right there where the previous 4 was. So maybe the INDA just needs to come down, test that 50-day moving average, retrace the previous 4, and then we start over again on a new pattern. But too early to say that. We could hold here at 50 above the wave 3 high, and then perhaps power on higher from there. We'll just have to wait and see. But kind of interesting to look at the international markets with the way they're differing a bit from where the U.S. is, at least slightly in their patterns, more in triangles, where we were really in an ascending pennant pattern. So they've been consolidating in a different way than the SPY had been, not following quite as much to the upside. The other thing that I wanted to show on the S&P that I did highlight in the weekend update was the difference in volume. When we had this move higher, I showed the volume on today's move, but the other key component of this rising pennant pattern was the fact that volume was falling off. And that's another sign that a breakout is imminent. When you get these little tiny bars into the point of the pennant, and then you have volume waning like that, something's getting ready to happen, and that's what happened. You saw it occur today. So reviewing our previous case study considerations, we only had 2 that can be considered still open. If you're new, you can go back. I invite you to go back and watch all these TradeFinder recordings. You can see that we've been pretty strong on our case study considerations here. on TradeFinder, and they're all listed there. You can see what we looked at and how they performed, etc. And so if you were following along with them, there'd only be two that are considered open. One of them is PFG. And so we looked at that last week. That was the move there. We were looking for it to come up and fill this gap up here, right around the 84 level, which is right where the lower part of this tap box is. By the way, the software is from the Hub organization, hubb.com. It's the best Elliott Wave software that exists in the market, in my opinion. And I've tried all the ones that I know to exist. I'm a big Elliott Wave fan, and so I'm going to trade with whatever software I think is the best. And I think this is the best one. And you've seen by all the targets that have been hit how well this operates. So here was PFG. We had a little bit of resistance here right at this previous wave 3 top. But we were expecting a move up to fill that gap, and boom, here's where we are now. And that was today. They had earnings after the close last night. They beat earnings and was going to have a great day until the market just rolled over and sold off, and PFG came down with it. But it did fill the gap. Look at that. It filled the gap just as we expected, and also hit the bottom part of the tap box. So I would call that a winner. It did exactly what we thought it was going to do. So the gap filled, hit the bottom of the wave 5 tap box. Is that the end of it? I think it's going to be difficult on the financials if rates continue to stay high. But if rates pull back a bit from their spike today and things resettle and we start figuring out a time frame to price in when, if and when the Fed is going to cut rates. Again, it keeps getting pushed out. As I said before, I never thought the March rate cut was going to happen. That's completely gone now. Nobody expects one in March anymore. And now we're out to people calling for June at the earliest. So I've heard a lot of May comments. That one would have seemed within reach without the CPI stuff today. Again, it wasn't that bad, I don't think. It was just tied in with an excuse to take profits, etc. But if we get a bad PCE report, if that comes in too hot, then yeah, it's going to be rates to the upside and the market to the downside, likely. So I think we call this one a winner when it did exactly what we expected to do. And then last week we looked at RGEN, and we were at this target here in the bottom part of the tap box, and we were wondering if we were going to have an extended wave 5 here. We had a roughly 38.2% wave 4 correction, which gives you the 61.8% extension. And so if it was going to go higher, it would go to the 100% extension. That's the next fib level to watch. And we felt like perhaps that was going to occur, and we were moving higher. As you can see, we hit a high here on the 8th of 203.99 and kind of went sideways there for a bit, and then it went down with the market as well. But we're kind of no harm, no foul. We're basically right where we were last week. So I think we can keep an eye on this one. I don't know that we need to necessarily get out yet. It could even come down and test that wave 3 high and still be okay, in my opinion. But it certainly bears watching. If there's some more follow through, then perhaps that wave 5 is over. It did move higher. It did move right into the middle of the tap box. So it did exactly what it was supposed to do. We were just looking to see if we would get an extension out of it, and perhaps that isn't going to happen. We'll watch that. We'll keep that on the list and take another look at it next week and see where it's gone from here. And I talk about these case study considerations here on TradeFinder. And what I wanted to show you was our website where we have at ewotrader.com trade alerts that are sent out to our subscribers. And the difference is at TradeFinder, we just look at case study considerations, and then you're kind of on your own as to how you manage it. With our alert service, we send out alerts for entries, exits, and any adjustments in between. So we kind of hold your hand through the process And you can see here, we sent out this alert on February 5th on Synopsys. You get all this information included in the alerts with the date, the contracts, what the pricing is trading at, and then we actually post what we are known fills, and you also have some commentary along with the chart. And we look at this, and then you can see that we had a zigzag pattern moving up with the wave 5 projection at the same spot. So where the C wave was to extend is right around where the wave 5 was. So when you have two Fibonacci Elliott Wave patterns giving you roughly the same target, that just gives you a better sense that this is likely to occur. Now, we were at a little bit of resistance there at the wave 3 high, but looking at the DMI, it was supportive that, hey, we're going to break through that level and continue up. And when we have these zigzag patterns in an impulse wave, I love them in the wave 3, but they work just as well in the wave 5. These are patterns that I like to trade, especially when you get more than one target around the same spot. So the wave 5 target as well as the zigzag target giving you the same rough target there, right around 600. And then we close this out on February 8th. So here's the exit alert that went out. And you can look at this and say, well, wait a minute, that's not at 600. I get this question a lot. Why would you close a position out before it hits its target? There's lots of things to consider. And remember, with trading, especially when you're an options trader, technical analysis is one part, but options analysis is important as well. And when we get a gap up like this, first of all, we gapped up. I don't like that. And then we have separation from the 10-day moving average. So we're overbought. Now we're right at the resistance of that wave 3 high. And when you get a gap up with a big day like this, they infuse the calls with implied volatility, and you want to take advantage of that IV rush. You could have the stock calm down, come back, fill this gap, go sideways for a bit, and then break higher. And so a week or so, the stock could be higher than where it is now, and the call's worth less. A really nice return, 72% in just 3 days. We're going to take that every time as well. So sometimes you just have profit exits, and you take your chunk out of the middle. You don't have to hit the bottoms or the tops. Nobody does that all the time anyway. But generating 72% in 3 days, yeah, we're going to take that every single time. So I wanted to share that with you. That was a really nice one on Synopsys that occurred last week. So let's go through and see if we can find a case study consideration, an official one for tonight. And we go to the scanners key and open this up, the pre-computed searches, find the stocks for you, searches the universe, so you don't have to go through page by page by page. And then over here, you can see these EWO searches, and that's for those that are alert subscribers at ewotrader.com, as well as have the software. They have access to these, and these are my searches. So those are my criteria that are programmed in here, and you can just click a button and see the results. As expected, there isn't many on the impulse search. That's the directional search. There's just one. So if we click on that, look at that. Look what it is. PFG. How about that? The one that we just said reached our target, and we were willing to call that one a winner. So bringing the chart back up of that, we'll had too many windows open there. Some of you are familiar with that. You have too many windows open. It has virtual memory to it. So let me get it right back up here, and then we'll move on. But you can gander at that Synopsys chart while I bring our software back up, and then we will see what we can find out for a case study consideration for tonight. I don't know if we want to do the PFG. We already said that we were going to take the gain in it, so I think we need to look elsewhere. Now, I will show one thing. It is interesting that it showed up on the search, but I stand by saying that that's a winner and we're done with it. But when you look at the chart of PFG, perhaps if we have a break above this 84 level and are off to the races. I'd be really surprised if that happens, just because of, I think financials are going to struggle a little bit in this current environment. But if we could break above this 84 level, then perhaps we have something going there. We didn't quite make it to the 61.8% extension with a perfect 38% wave 4 correction. So there may be more to the upside here. Again, it looked like it was going to be a huge day until it just succumbed to the selling in the market. So maybe we get another shot at this. In fact, you could argue, I oftentimes give some analysis for those that are conservative and those that are aggressive. We all have different risk tolerances, and you have to trade according to your own. Some people are more aggressive by nature. Some like things more conservative. Aggressive trade would be if we got back above 81, just broke above that wave 3 high again. If we got back above that, you could take a look to go long here. But the more conservative target would be breaking above that 84, which is where the congestion was in July, the gap that we filled today, et cetera. Regardless of whether you're conservative or aggressive, I guess I'm saying I think it's still a wait and see. So couldn't bring this back as another official case study consideration for this week's TradeFinder. I think we need to just kind of monitor what occurs over the next few days here. But that would go on the watch list. And I would take a look at it and say, well, maybe we want to take another look at this, but not until it broke above 81. So even from an aggressive stance, you'd want to see it break 81. If it did, then maybe it becomes interesting. Again, we'll see where it is there. But I did have one that I was looking at earlier today, and this is from the AI department at Hub. And it's a pretty interesting one on GPC. And you take a look here, you can see it's in a wave 3 to the upside, came down a little bit today, as you would expect, trading right at the 10-day moving average. But look what's going on here. So we have a nice movement to the upside here in the wave 3, kind of at a 45-degree angle. And we have a gap above that needs to be filled. And so perhaps the stock is just climbing up to fill the gap, exactly what we talked about with PFG moving higher. So whether or not we go a whole lot higher, I think there's an argument to be made of coming up to the gap. And again, just like PFG, where the gap is happens to coincide with where this tap box is. Now, just a quick commentary here. This comes up all the time. I've said it numerous times, but we always have new people. This 4 here doesn't mean that we're in a wave 4. This means that if the wave 4 were to start, 3 is the current labeling. That's the wave we're in. We're in a wave 3 to the upside. If the wave 4 were to begin today, that's where you could expect to find support. So these are just projections. But for whatever reason, the Elliott Wave algorithm likes this target around 150 on genuine auto parts, 148, call it, which is exactly where that gap was filled. So we're zigging and zagging here. I really like the pattern here. You all know I like zigzags, and there's a bunch of them within this one. And so, yeah, it fell down today, but it wasn't that bad considering what was going on in the market. And we currently have a pretty nice zigzag here. So if we take a look at that, we're right at the 61% extension or correction on the B wave, which is my favorite. And that gets you to look for 100% extension on the C wave. And that's exactly where the bottom of the tap box and filling that gap is. So you've got a number of things calling for 148 on GPC, barring, more ugly days like the market had today, bad tapes as they call it. So I think that there's a pretty strong case to be made for GPC to go up to 148. So that's going to be our official case study consideration. We aren't quite ready to start looking at downside trades. Maybe next week things will be different, and we will be. I kind of welcome that. It's been a while since we've had enough of a downtrending market to put on a lot of bearish trades. We had a few in 2020 when the market went down, but it went down so fast it didn't allow for that many trades. We had some great downside trades then, but just not an opportunity to put too many of them on because it just went so fast. So we're going to say GPC up to 148. That's going to be our official case study consideration for tonight. And we will cross off PFG, and maybe we bring that one back again if it breaks above 81. We'll keep RGEN on and see how that acts if the market does stabilize a bit from the rough sell-off that we had today. So with that, Zach, if your throat will allow you, open to take some questions from the folks.
Yeah, no, I think I can power through. It's hopefully I'm not too terrible to listen to on the other end. So we'll start out here first with PANW for our friend Will on YouTube.
Good Palo Alto comes up periodically. You can see a nice wave 3 here, and this is like antivirus software type stuff, and other things that they do, cybersecurity, all that kind of stuff. And it's been on a nice run. When you see this movement to the upside here, this is a little bit vertical for me. I don't like the big vertical moves, as you know, but it had a nice consolidation. So if you're going to have something move kind of vertically like that, that's about as ideal of a consolidation as you could ask for. It just went dead sideways for a while, let the 10-day moving average catch up to it, and then it exploded higher. We got a little bit above it and then came back down. You can see that on the low, we traded just below the 10-day moving average, but we're still able to close above it. So it still looks pretty constructive. When we look at the DMI, the ADX, it's in a high area here around 40. That's where you start to get a little concerned. When the ADX gets up to about 40, it's telling you the strongest part of the trend is over. It doesn't mean the entire trend is over, but the strongest part is over. So stocks can still move higher with a really high ADX. It's just you have to be kind of on your toes watching it, because at some point in time, that ADX will break back down as the strength of the move wanes. But things can still go higher weekly, just like the SPY did, with weakness, I should say, just like the SPY did in that ascending pennant pattern. Same exact scenario can occur on any stock, even with a high ADX. The problem here is not so much that the positive directional indicator came down. You would expect that on a weaker day, but the concern here would be that the negative directional indicator came up. So there was some sellers that felt a little bit emboldened today. And so I would watch that. You would want these two to turn back around, the positive to go back up and the negative to go back down. But I would say that if you're long this stock now, as long as it stays above this consolidation at 340, you're probably okay. Even if it came down and tested that level, because once it broke from it, this is the old launch pad effect that we used to talk about a lot, being from the Space Coast. You have this sideways, just dead sideways horizontal consolidation, acts like a launch pad. Boom, you get a blast off. And that's what happened with Palo Alto. And it never really came down and tested that. And maybe that's all that's going on now. So again, if you're long, I think you're okay as long as it stays above 340. If it broke that, then I think you need to be out, because that may be the beginning of the wave 4. And you would want to see this DMI reform itself a little bit, with the positive directional indicator going up and the negative going down. That's a good one to start with.
Agreed. All right, let's go over to Zoom. We have a question from Emmanuel here. Please let me know what you think of the technical show for Affirm. It looks like it's getting ready to break key technical support, taking you to 25.
You're right. It does look like it's about to break down from key support. 40 is where it needs to hold. And certainly the consumer debt information that was released a week or 10 days ago, maybe 2 weeks time, moves so fast now, that was showing that the consumer has $17.5 trillion of debt. And on top of that, credit card delinquencies are on the rise quickly. None of those are good for continued consumer spending or people paying their loans or the financing that they used through Affirm for the end of the year. So yeah, this is a little bit troublesome. It tried to break higher. You can see it bumped its head at 50, where there was some resistance with the previous wave 3 high. It couldn't get through it. And now we're back. It needs to hold right in here. If it doesn't, then yeah, this could be a nice move to the downside here. You know, we're broadening out, Zach, with our commentary. I saw on the U.S. market update a couple comments of Katie bar the door, so it's getting around.
Yeah, the exposure is reaching out.
Yeah, this is almost one of those. That would be a pretty ugly move. But again, as was it Emmanuel that asked the question? Spot on. 40 is support that needs to hold, and if it doesn't, then 25, I would agree, is the next level. So I agree with your read perfectly. I don't think you can go long this stock unless it can break above 50. And if it breaks down with some follow through here, I think you have a pretty good short trade down to 25. So I'd be looking this one more of if we get some follow through below 40, that could be a really good short trade down to that level. That's a pretty good move. So you could let it go a little further to confirm it, and then step in there. So yeah, I'm totally with you. In fact, I'm gonna put that on the watch list as well, and see if we get follow through to the downside tomorrow. There, I'll be curious to see if it breaks below 40, but it's got to do that first. And when we talk about these support levels, sometimes they hold. It's got to actually break it. It's trying, but you can see it tried back here in early February, on February 1st, and the very next day there was no follow through. It moved back up, and that could occur again tomorrow because we're right at the 50-day moving average. But if we get another lower close and confirm this break of 40, then that's a different story. So that confirmation day, the follow-through day, is so important. I talk about it a lot. There's a lot of head fakes that occur in the market, and you want to just be patient enough to let the pattern set up. Again, we don't have to pick the tops and the bottoms. We want to take our little chunk out of the middle. So, all right, I'll stop babbling, Zach, so we can get another question.
No worries. Yeah, I was going to say good spot there, Emmanuel, and Emmanuel says thank you. So real quick before we go over to the next question, I do just want to say or ask you to remind everyone of what time your hub show takes place on YouTube. We had a question come in around that, so I figured it'd be good to announce it in case there's others that might be wondering.
Yeah, great question. It's at 2 p.m. Eastern time. So if you haven't done so, go to YouTube and the Hub Financial channel on YouTube. So every Friday at 2 p.m. Eastern time. So love to have you join us. It's a great show.
Absolutely. I second that. And let's go over to PLTR for Fluffy. And we also had a question come in from Michael on PLTR as well. So I'm going to go ahead and drop the Hub Financial chat or Hub Financial YouTube link rather for their channel into the chat.
Perfect. Sounds great. Yeah, it's a live show and it's during market hours, so it's awesome. We do one on Mondays as well on EWO Trader Live with Zach himself. So love to have you there. That one's at 11 a.m. So a little bit earlier in the trading day. But PLTR, they mentioned the magic words. I'm sure you heard it. AI, and so there we go. We still are catching a bid in stocks that haven't participated in the big massive runs like NVIDIA, et cetera. And they're looking for places to go to catch early parts of the move. And you saw that there. And we're still a little bit overbought here. We got really overbought. I hate the gap up. I don't like the vertical stuff. So those things are concerns just for me personally. That's just what I've experienced over time. And when you get burned a few times and you form your rules, it's hard to change much. Sometimes stocks go vertically up and continue up, a la SMCI. Which I think we talked about last week, and I was saying I couldn't chase it here. It was at 700, and maybe it runs straight to 800, but I couldn't chase it. Guess what it hit today? 800. So, sometimes these vertical moves can continue, but at some point they come back down. And oftentimes what goes vertically up, I'll save your voice, Zach, come vertically back down. So I'm a little concerned about the separation from the 10-day moving average here, but as I said, they mentioned the magic words, so you could keep an eye on this. It does have a pretty constructive DMI, slight tick up there on the negative directional indicator, but we probably saw that across the board today with all the selling pressure that was going on. But I would keep an eye on this one. Perhaps it catches another bid. The algorithm does like a move up from 27 to 29, somewhere in there. And, maybe you can catch another part of this move. Again, as long as the market isn't really about to break down here, which could happen. But we need a follow-through day there just as much as a follow-through anywhere else. But slightly overbought here. If we get some more sideways consolidation and that 10-day moving average catches up and it doesn't come vertically back down, maybe that gap gets filled sometime in the future. That's the nature of gaps. Most of them get filled, but we don't always know when. Sometimes it's immediately and sometimes it takes some time. So that's the issue there. So it just depends on if the institutions want to continue to pile in here. When you get this vertical stuff, there's short covering as well. You can see it blasted above resistance and just took off. So it wasn't all buying. Some of this was short covering too. So it would take some legit buying, I think, to push it much higher from here. Usually when that calms down, the short covering ends. And now it's left to see, is anybody going to step in? Anybody else going to step in and buy it? Or was that it? And that's when they come straight back down. But certainly worth watching for sure.
Alrighty, so this next one is one I find super interesting as well. It's from Young here on Zoom. Would like your thoughts on NVDL. It's the ETF for NVIDIA.
Isn't that something else? NVIDIA is so hot, it's got its own ETF. That's amazing. Yeah, just the love of the stock is just like it used to be with Tesla. But big move to the upside here. And NVIDIA went higher than I thought it would. This has followed along a bit as it's supposed to, being an ETF. Now this looks pretty constructive. You can see the low actually stayed above the 10-day moving average. We didn't even hit the 10-day moving average on the low of the day. You can see that the ADX is always up at 50. That is getting kind of extended. Once it goes above 40 is when you start saying, the strongest part is over. And I've talked about this before, but it bears repeating. With the DMI, the range is from 0 to 100, but you rarely see the ADX go above 60. I'm curious as to why Wells Wilder made the range from 0 to 100, because I can only remember a few times when I've seen it above 60. This is no doubt a strong move in NVIDIA. There's conviction behind it. So I don't think there's going to be any sort of nasty sell-off. If the market corrects, then it'll come back down and correct a little bit as NVIDIA will. But it looks pretty constructive right now. I think if you wanted to stay in this, you would want to see it hold that low that it had today. It was able to go down to it and bounce off of it nicely, closing at 169, where it hit 157 on the low. So I think you could stay long this as long as it stays above 160, but a break below 160, and now you're bringing all the way down here to 120 into play. And that's probably telling us that we have rates going up and market going down, especially the Qs and tech stocks. But interesting one to look at. I thought I would show them the chart of SMCI. I'm always happy to pat myself on the back when I'm right, but that's about as high as you're ever going to see the ADX there. You can see it's at 70. So that goes into the handful of times I've seen one above 60. And there's that move where we were at 700 and I just can't chase that. Maybe it runs straight to 800, and it did, right straight to it. And I just can't chase those vertical moves. There'll be another point of entry at some point in time when this calms down, but that's one I would have missed right there. But I just thought I'd share that it actually hit 800. So yesterday and today, as a matter of fact. Okay.
Yeah. Yep, that is quite a chart to look at. All right, let's go over to TNDM for JPO on YouTube.
TNDM?
Correct.
Okay, that's a new one. Um, I don't know that I've ever looked at this chart before. So that's one of the great things about trade finders. You all ask such great questions. And you always have interesting stocks to look at. It's a great community here. So looking at the support resistance is right there at 25. You can see we bounced off of it. It was support back in the summer, June and July. We broke below it in September, traded back above it in the middle of December, came back, went sideways for a bit, then just broke and kind of consolidated right underneath it. Now we're back up testing it today. And, this could actually catch a bid if the market weakens and some of the popular stocks that money has been in starts to rotate out. It'll be looking for other places to go that maybe haven't participated as much. And I'm assuming diabetes care is in the healthcare area here, and those are known as defensive sectors. And that's where money goes to hide when the market corrects a bit. So I would want to see a break above 25 with follow through. If you got that, I would say you probably at least test this wave 3 high just above 30. But again, this is not enough today. I would want to see a clean break of that 25 level with a follow through day. And then I think the rest of the move, you could probably catch to the upside there. Again, at least to that wave 3 high. Pretty
Very
interesting.
well. Second symbol is IEP.
Good old icon. You can see it's I assume this is Carl's UNT here. Boy, it's had a nice move, and we are right here at this point of resistance. We only got a 29% extension on the wave 5, but we only had a 23% wave 4, and that's what causes the confusion and why Elliott in his writings didn't like the wave 4 at 23%, because you would have expected that wave 5 to maybe go a little bit lower, but it didn't. And then again, that's one of those issues there. So it's caught itself and moved back to the upside. It's right back to where the previous 4 was. So that's what's supposed to happen when the wave 5 ends. So this one's in doubt. Now it had this big, huge gap down here, which looks awfully inviting, I'm sure, to people that are looking at this stock. But I would need to see a break above 20 with follow through. If it could break above 20 with follow through, then perhaps this one continues higher. Does it look to fill this gap? Perhaps not. I don't know, but that's certainly interesting. But this is a big area of resistance where it is right now, with the previous 4 being an area of support back from the end of summer, early fall, and we're right back there. So it needs to clear that. So a break above 20 with a follow through day. And yeah, that one would look pretty inviting to the long side from there. But it's got to do it first. And there's some resistance where it is now.
Yeah, we'll keep that one on the watch list, but definitely something we definitely might enter some type of position on, depending on if it breaks. So I see we're at 10 on the hour or on the dot. So I'm happy to stay on and pass through as many questions as you like, but totally up to you.
We'll do 1 or 2 more, and then we'll let the folks get on with their night.
All right, so this one's going back to the SPY. This is a question from SP on Zoom. If the retracement continues on the SPY and wave 4 develops, where can you anticipate it moving to based on the Elliott Wave 50% or 61.8%?
Gosh, I wish I knew that. But the wave 4 is down here at 460, and I've been talking about this for quite some time. Even as the market has powered higher, I would have liked to have seen it test that level in January when we had this little move lower, because that's a point, it was major resistance. We broke above it, and we never tested it. Even with this move down in January, I was hopeful that we would come down there, would have felt more confident in this upward move, even though we did get a lot of nice bullish trades out of it. But there would have been a stronger point to bounce off of. So that's exactly where the wave 4 is forecasted. I think certainly a 50% correction would be a strong point of support. A lot of people watch that. And we would just have to see what the confirming indicators say once we get there. And then we can take a look to see if 61.8 is in the cards. But just from a pure support standpoint, that strong support is right there at 460, and it does split that wave 4 forecast. So if it makes it down that far, then we'll look at the indicators and see if they're telling us that may be it for the selling or more to the upside. And again, this is if the market continues lower. We could turn back to the upside tomorrow. It just depends on how the market wants to digest this. And perhaps we just kind of go a little sideways till we get that next PCE report. I'll have to look up and see when that's coming out. So one more, Zach.
All right, well, we'll wrap up tonight's session with good old Roku, ROKU for YT on YouTube. And just want to remind everyone out there that's watching live, if you've enjoyed the session, please go ahead and hit that like button for us. It goes a long way and bumps up that algorithm, so we really appreciate it. Other than that, thank you for joining us for this live session, and I'll pass it over to Rob to wrap things up.
Thank you, Zach. And yeah, we do appreciate the likes and joining us each and every week. So moving up to the 100 level was expected, I think, because that was an area of resistance. We're not in a 5-wave pattern, which is really interesting. So when I look at that, first thing I note is appearance of a big zigzag here. And it is, and there's a 50% correction right there for SP. And the first level would be 61.8. If it can hold 90 is the key here, because that is clearly, you can see support resistance in this 90 area. Broke below it back here in January when we had that sell-off that I was talking about. And it was able to hold this next level of support in the 80 area. So there is some pretty good support between 80 and 90. So if you wanted to take an aggressive shot here, you could. But if you want to be more conservative, let it break above 100 with a follow-through day, because you still have plenty of room up to that 114 level, 61.8. And, you start looking at stocks like this, kind of with that COVID theme, people staying home. If the consumer is riddled with debt, perhaps don't travel as much, not as many vacations, etc. And stocks like this it's just a sideways range, and I don't really see much of a trade one way or the other. But a break above 100 would be interesting, and a break below 80. And I think we can bring it out here, Zach, on the last chart of the day. That would be a Katie bar the door candidate there, because that brings us below 60. That's a big, huge move there if it broke below 80. 80 to 100 is just a trading range, I think, but those are the two levels to watch as far as being bullish or bearish. So thanks everyone for joining us. As Zach mentioned, we really appreciate it. Hope you have a great rest of your week and look forward to talking again next week. Take care, everybody.